EPK Capital presents Daily Brief for 8 September 2025. Hello everyone! Welcome to EPK Capital's Daily Brief video. I am your host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Opening remarks, the jobs report that shook the world. Today, we're going to dive deep into a day of trading defined by a single, pivotal event: the release of the August jobs report. This wasn't just another data point. It was a bombshell that created a macroeconomic puzzle, igniting a powerful contradiction that rippled across global markets. For months, the narrative has been one of a resilient U.S. economy, with strong corporate earnings and a robust, if cooling, labor market. But the August jobs report fundamentally challenged that perception, setting a weak labor market on a collision course with a seemingly booming economy. This great disconnect is the central theme we will unravel, exploring how a few key numbers upended market expectations and solidified hopes for a major monetary policy shift. The immediate reaction was a whirlwind of confusion. The headline figures of the jobs report initially spooked investors, prompting a sell-off in U.S. futures and leading to a slide after the market opened. However, as the day progressed, a more dominant narrative took hold. The surprisingly weak data was seen by many as the final piece of evidence the Federal Reserve needed to justify an interest rate cut at its upcoming September meeting. This prospect of a more accommodative monetary policy provided a floor for the market, preventing a full-blown panic and creating a complex day of trading, where indices flirted with record highs before ultimately closing lower. A tale of two tapes: global market performance on September 5, 2025. The day concluded with a notable retreat for the major U.S. indices, despite an early rally that saw them touch new record highs. The Dow Jones Industrial Average shed 0.5%, capping off its second consecutive week of declines. The S&P 500 fell 0.3%, and the tech-heavy Nasdaq Composite finished the day fractionally lower. Despite this Friday slip, the underlying trend remains one of remarkable strength. Both the S&P 500 and the Nasdaq managed to close the week with modest gains, rebounding from declines the previous week. All three major indices continue to hover near or at record highs, a testament to the market's enduring momentum despite growing economic headwinds and policy uncertainties. The reaction in international markets was a study in divergence. While U.S. indices slipped on the domestic data, Asian markets generally finished in the green. The Nikkei 225 in Tokyo jumped 1.0%, while Hong Kong's Hang Seng Index and the Shanghai Composite also saw gains of 1.4% and 1.2%, respectively. Europe, however, was a mixed bag. Germany's DAX closed down 0.7%, and Britain's FTSE 100 slipped 0.1%. This differing reaction across continents underscores a critical theme. While global markets are undeniably interconnected, their responses to a single event are filtered through their unique economic lenses. Asian and European markets, in particular, may have interpreted the weak U.S. jobs report not as a sign of global economic weakness, but rather as a highly favorable signal. A soft U.S. labor market makes a September rate cut from the Federal Reserve a near certainty. This potential loosening of U.S. monetary policy is expected to weaken the U.S. dollar, which is a bullish signal for other economies. A weaker dollar can boost the exports of countries in Asia and Europe, potentially providing a tailwind for their own growth. This complex interplay shows that a negative data point in one economy can be perceived as a positive catalyst elsewhere, creating a patchwork of reactions rather than a unified global movement. The day's trading was marked by a clear split between winners and losers. On the winning side, the AI narrative continued to dominate. Chip giant Broadcom surged more than 9% after reporting strong quarterly results and, according to reports, securing a new multi-billion-dollar customer in OpenAI. This positive news was contrasted by another major chipmaker, Advanced Micro Devices, AMD, which tumbled 6.6% after a downgrade pointed to slowing demand for its AI accelerators. This contradictory performance illustrates that the market's enthusiasm for AI is maturing and becoming more discerning. It suggests that the AI infrastructure spending boom may be consolidating around a few key players, creating a more selective, winner-take-all dynamic, rather than a broad-based, industry-wide rally. Other notable winners included T. Rowe Price and Goldman Sachs, which gained on news of a new partnership. Shares of home goods retailer Williams-Sonoma and the broader home building sector rose, buoyed by the prospect of a Fed rate cut, which would likely reduce mortgage rates and stimulate the housing market. Amazon's stock also climbed, driven by a new deal for its Project Kuiper satellite internet business with JetBlue. However, there were significant casualties. Lululemon Athletica shares plummeted 18.6%, the largest drop in the S&P 500 for the day. The athletic apparel maker trimmed its full-year guidance, citing tariff impacts and sluggish U.S. sales as the primary reasons. This is a crucial data point, as it provides a direct, tangible link between the administration's trade policy and a major corporate failure. Additionally, shares of Kenvue, the maker of Tylenol, dropped sharply after a report from the Department of Health and Human Services suggested a link between the painkiller and autism. The centerpiece of today's market action was the August jobs report, and the numbers were a jolt to the system. According to the Bureau of Labor Statistics, the U.S. economy added just 22,000 new non-farm payroll positions, a stunning miss compared to the consensus forecast of 110,000. To put that number in perspective, the average monthly job gain has slowed to just 29,000 over the last 3 months, a sharp decline from the 82,000 average in the same period a year ago. Even more concerning were the significant downward revisions to previous months. Data for June was revised to show a loss of 13,000 jobs, marking the first negative reading since December 2020. These revisions confirm what some analysts had suspected. The summer labor market was far weaker than previously reported. The unemployment rate also ticked up to 4.3%, its highest level since late 2021. The slowdown was broad-based, with key sectors like manufacturing, construction, professional and business services, and the federal government all shedding jobs. The weak jobs report stands in stark contrast to other recent, more positive economic data, creating a puzzling picture of the U.S. economy. The second quarter GDP, for example, was recently revised upward to a robust 3.3% annual rate. Furthermore, the Atlanta Fed's GDP estimate for the third quarter is projected at a solid 3%, and industrial production is at an all-time high. This has created a fundamental puzzle for economists. How can GDP and industrial production be booming while the labor market is at stall speed, as one economist put it? The explanation lies in a phenomenon economists refer to as rising productivity. This is the ability of an economy to generate more output with fewer workers. The evidence suggests that U.S. businesses, facing a combination of trade policy uncertainty, high interest rates, and a desire to cut costs, are investing heavily in automation and artificial intelligence. This strategic shift allows them to increase production without hiring, leading to the peculiar situation of record-high industrial output and declining manufacturing employment. While this trend speaks to the increasing efficiency of the U.S. economy, it carries significant risks. A labor market that is decoupled from economic growth could lead to persistent unemployment and make the economy highly vulnerable to a recession. The market is now grappling with the implications of this new reality, where corporate profitability is rising, but job creation is not following suit. The seemingly random negative data points of the past few weeks are not isolated events. They are part of a clear causal chain that can be traced back to the administration's trade policy. President Trump's sweeping tariffs on imports from around the world have had a multi-layered impact on the economy. First and foremost, tariffs are a tax on American businesses and consumers. The initial announcement of these tariffs led to a front-loading effect, where businesses and consumers stockpiled goods in advance of the levies, artificially boosting economic activity in the first half of the year. That artificial boost is now fading and turning into a drag. The full effect of the tariffs is starting to be felt, as seen in Lululemon's profit warning, which directly cited tariff impacts and sluggish U.S. sales as the reasons for its poor performance. The heightened uncertainty and rising costs associated with these trade barriers are also depressing business sentiment and squeezing household purchasing power. The weak August jobs report, with its job losses in manufacturing, construction, and wholesale trade, is a direct result of this policy. It shows that the economic resilience seen in the first half of the year may not be sustainable as businesses absorb higher costs and consumers face an estimated average of $20,400 per year in tariff-driven inflation. Political undercurrents and monetary policy on a collision course. The August jobs report has made a September interest rate cut a foregone conclusion for many analysts. Prior to this report, the market was already pricing in 3 rate cuts this year. The weak labor data provides the Federal Reserve with the necessary ammunition to act, but it forces them onto a political tightrope. The decision comes against a backdrop of intense public pressure from President Trump, who has consistently pushed for immediate rate cuts. The administration's top economic advisor has publicly called for the Fed to remain fully independent from political influence. This creates a complex and difficult situation for the Fed. By cutting rates, it would be taking action to support an economy that shows clear signs of weakening, particularly in the labor market. However, in doing so, it risks appearing to capitulate to the very political pressure it claims to be independent of, which could damage its long-term credibility as a nonpartisan institution. This is not a simple economic decision. It is a high-stakes political and institutional choice that will have lasting consequences for the central bank's relationship with the government. The debate over the Federal Reserve's independence is no longer a U.S. domestic issue. It has become a matter of global concern. In a recent high-profile statement, European Central Bank President Christine Lagarde warned that President Trump's war on the Fed is a very serious danger to the world economy. Her comments elevate a U.S. domestic policy dispute to the level of a global economic risk. Lagarde emphasized that if U.S. monetary policy were to become dependent on political dictates, it would have a very worrying impact on the largest economy in the world and, by extension, on global financial stability. This public warning from a key international figure signals that world leaders are genuinely concerned about the potential for the U.S. central bank to lose its institutional integrity. It also highlights the broader geopolitical tensions that are already elevating economic uncertainty around the world, from trade frictions to ongoing conflicts. Alternative assets. Gold's haven and crypto's conflicted momentum. In a day defined by economic uncertainty, gold once again solidified its role as the ultimate safe haven. The precious metal hit a new record high, trading as high as $3,597.66 per ounce. The weak jobs report, which added a new layer of economic concern, sent a flood of haven flows into gold, with investors seeking protection from both economic stagnation and the potential for a new wave of inflation spurred by tariffs and government policies. For these reasons, gold has established itself as the ultimate policy hedge. The cryptocurrency market is experiencing a conflicted momentum. While the prospect of a Fed rate cut is seen as a major bullish catalyst for digital assets, the short-term price action tells a different story. Bitcoin, which has been hovering near the $111,000 mark, failed to clear a key resistance level of $114,000, and its momentum remains unconvincing. Ethereum has fared worse, falling by nearly 2% in the last 24 hours and over 3.5% for the week to trade around 4,226. The price slide is attributed to continued ETF outflows and weak seasonal trends. The price action reveals a maturing crypto market that is highly sensitive to macroeconomic factors. While a looser monetary policy is a long-term tailwind, short-term pressures such as institutional selling via ETFs and direct competition from traditional safe havens like gold are creating significant headwinds. This shows that crypto is no longer a fringe asset. It is behaving more like a high-risk investment class that is highly correlated with broader market sentiment. In corporate crypto news, Faraday Future announced a new allocation of $2 million to its C10 treasury, which is managed with an 80% passive index and 20% active management strategy. The company has also officially begun staking its crypto coins, a practice that aims to provide enhanced yields and risk mitigation through participation in major ecosystems like Ethereum and Solana. This news, along with other notable developments like Elon Musk's lawyer chairing a Dogecoin treasury and a Solana-backed firm expanding to the UK, signals a broader trend of institutionalization and corporate integration of crypto assets. Concluding synthesis, what to watch for next. The events of September 5th, 2025 have created a complex and challenging economic narrative. The surprising weakness in the August jobs report has set up a critical showdown between a labor market that is at stall speed and an economy that is otherwise booming. This is not just a statistical anomaly. It is the manifestation of a fundamental shift in the economy driven by rising productivity and the ripple effects of international trade policy. The administration's tariffs, initially designed to boost domestic manufacturing, now appear to be depressing business sentiment and squeezing consumer spending, as evidenced by corporate profit warnings and job losses in key sectors. All eyes will now turn to the Federal Reserve's upcoming meeting. The weak jobs data has provided the central bank with the economic justification it needs to cut interest rates. However, the decision is fraught with political risk, as the Fed's independence from political pressure is being openly challenged. Any action it takes will be viewed through this lens, and the market will be watching to see if the central bank can navigate this treacherous political landscape. Looking ahead, we must continue to monitor the conflicting economic signals. Will consumer spending hold up in the face of persistent inflation and rising unemployment fears? Will the productivity gains we are witnessing translate into a new era of growth, or will they simply lead to a less stable economic environment? We will also be watching for new economic data releases and any new political comments that could add to the market's considerable uncertainty. The current environment is not just about numbers. It is about the fundamental forces reshaping our economy, from technology and trade to politics and monetary policy. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.